You did everything right. You didn't blow your money on stuff you didn't need. You didn't gamble it on some coin a guy on the internet told you would 100x. You put it in a savings account like a responsible adult, and you watch the little number go up every month thanks to interest. Congratulations. You're still losing money, not eventually, not if something goes wrong. Right now, today, while you're reading this, your safe pile of cash sitting in that savings account is quietly shrinking in real terms, and your bank is never going to be the one to tell you that. This isn't a scam in the illegal sense. Nobody's stealing your money outright. It's something sneakier. A system where the numbers go up, but what those numbers can actually buy goes down faster. And almost nobody explains it to you because the people who benefit from you not understanding it are the same people handing you your monthly statement. Let's break down exactly how this works. The number is going up. That's the trap. Say you put $10,000 in a savings account paying 2% interest. After a year, your account says $10,200. That feels good. The number went up. Your brain registers that as I made money. But here's the question nobody asks. Did $10,200 today actually buy more than $10,000 did a year ago? If inflation that year was running at 3%, then prices on average rose 3%. That means the stuff that cost $10,000 a year ago now costs roughly $2,300. Your account grew to $10,200. You're $100 short of even breaking even, and that's before taxes on the interest you earned, which take another bite out of that already losing number. You made money in nominal terms. You lost money in real terms. And real terms are the only terms that actually matter because you don't eat numbers. You eat groceries that those numbers buy. This is the entire trick. Banks advertise the nominal rate, the headline number, because that's the number that sounds good in a commercial. Nobody puts, your money will lose 1% of its real value annually on a billboard, even when that's the honest math. Why this isn't an accident. Here's where it gets uncomfortable. This gap between your savings rate and inflation isn't some unfortunate coincidence. It's baked into how the entire financial system is designed to function. Banks take your deposit and lend it out at a much higher rate than they pay you. You get 2%. They lend that same money out as a mortgage, a car loan, or a credit card balance at 6%, 8%, sometimes 20% plus. The spread between what they pay you and what they charge borrowers is, in a very literal sense, their entire business model. The lower they can keep your savings rate while still keeping you as a depositor, the more profit they pocket on the spread. Now zoom out further. Central banks set the baseline interest rate environment for the entire economy. When a central bank wants to encourage borrowing and spending, which is most of the time because growth and spending are what get politicians reelected and what keep GDP numbers climbing, they tend to keep interest rates low relative to inflation. Low rates make borrowing cheap. Cheap borrowing fuels spending. Spending fuels growth. But low rates relative to inflation also mean savers get punished. It's the quiet flip side nobody puts in the press release. A policy designed to boost borrowing and spending is, by mathematical necessity, a policy that makes saving cash less rewarding. There's no version of make borrowing cheap that doesn't also mean make saving comparatively less attractive. You can't have one without accepting the other. This is sometimes called financial repression, and it's not a conspiracy theory. It's a recognized economic dynamic. Governments and central banks have, at various points in history, deliberately kept interest rates below inflation, specifically because it helps reduce the real value of debt over time, including government debt. If a government owes $1 trillion and inflation quietly erodes the real value of that $1 trillion debt while interest rates stay artificially low, the debt becomes easier to handle in real terms. Your shrinking savings account is, in a very indirect but very real way, helping make somebody else's debt easier to pay off. You're not the customer in this relationship in the way you think you are. You're the funding source. The inflation number, you're told, isn't the inflation you feel. Here's another layer that makes this worse. The official inflation rate that gets compared to your savings rate is often an average across a massive basket of goods. Electronics, used cars, services, rent, food, energy, all blended together. But you don't spend money on the average basket. You spend money on rent, groceries, insurance, and whatever else actually makes up your life. And those specific categories, especially housing, healthcare, and education, have, in many recent years, risen in price noticeably faster than the broader headline inflation number. So even when the official inflation rate looks roughly close to your savings rate, your personal inflation rate, the one based on what you actually buy, might be running well ahead of it. Which means the real erosion of your purchasing power could be even worse than the official math suggests. This is why so many people feel like they're falling behind, even when the news says inflation is under control. The chart on the news isn't lying. It's just not measuring your specific life. Why just don't spend it doesn't save you. The instinct a lot of people have is, fine, if spending is risky and saving is being eroded, I'll just hoard cash and avoid both. Don't invest, don't spend, just hold. This is exactly the trap, because holding cash is not neutral. Holding cash is an active decision to guarantee that your money loses value over time, just slower than if you spend it on something that depreciates even faster. There's no safe option that preserves your purchasing power by doing nothing. Doing nothing is itself a bet that your money sitting still will somehow be worth the same later, when literally every modern economy is structured around currency slowly losing value year over year. Inflation isn't a bug in the system. It's closer to a deliberate target. Most central banks explicitly aim for a small positive inflation rate every year, commonly around 2%, because they believe a small amount of inflation keeps an economy functioning smoothly, encourages spending over hoarding, and avoids the dangers of deflation, where falling prices can cause people to stop spending entirely while waiting for things to get even cheaper. So the system isn't broken, it's working exactly as designed. The design, though, just happens to include the slow erosion of cash sitting still. Your savings account isn't a flaw in the matrix, it's a feature. What actually keeps pace and what doesn't. This isn't a video telling you to dump your savings into anything risky. Having cash on hand for emergencies, short-term goals, and stability is genuinely important, and there's real value in not having to sell investments at a bad time because you needed quick cash. That safety is worth, even if its real value erodes slightly over time. But it's worth being honest with yourself about what role that cash is actually playing. If it's your emergency fund, fine. That's insurance, not growth, and insurance isn't supposed to make you rich. The problem is when people treat their entire savings account as if it's their wealth-building strategy, when by design, it's structurally guaranteed to lose ground to inflation over any meaningful stretch of time. Assets that have historically had at least a chance of outpacing inflation over long periods, stocks, real estate, and various other investments, come with their own risks, volatility, and no guarantees. Nobody can promise any of them will beat inflation in any specific year. But a savings account isn't even trying to win that race. It's not designed to beat inflation. It's designed to be safe, liquid, and convenient. And that convenience comes at the quiet cost of guaranteed long-term erosion. The real takeaway: your bank isn't lying to you when they show you that interest accumulating in your account. The number is real. It's just incomplete. It tells you what you have. It doesn't tell you what that amount can actually buy. And that second number, the one that actually matters to your life, has been shrinking the entire time, quietly in the background. While the headline number gives you just enough comfort to not ask questions. The system isn't designed to rip you off in some dramatic, illegal way. It's designed to keep money moving, keep borrowing cheap, and keep debt manageable for everyone above you in the system. And your sitting cash is collateral damage in that design, whether anyone meant it personally or not. The next time your bank proudly tells you your savings account just paid out interest, ask the only question that actually matters. Did it grow faster than prices did? If the answer is no, you didn't gain anything. You just lost a little slower than the person who kept cash under their mattress.